Okay, good morning to the student in the classroom and the online student. So today we are going to discuss Chapter 2, Financial System. So for me, financial system include financial market and financial institution. And I will suggest our student to consider the following 3 chapters together. Chapter 2, Financial System. Chapter 3, Financial Market. Chapter 4, Reserve Bank. All right. Okay, so when I think about financial market and the financial institution, I know they are a link between money provider and the money user. So you can see the following 3 chapters are about this topic. All right. So this chapter, we have 4 topics. We like to cover the first 2 topics today, right? Financial system and the type of financial markets. So you can see in finance, we have different types of financial markets. The reason is simple. We want to give more option to investor, right? So we can attract more investor to the market. So comparison is important. So when we introduce each financial market to you, finally, I hope students can understand the differences between them, right? So let's discuss our first topic, financial system. So financial system consists of financial markets and financial institution. So financial institution means banks. And this market and the institution provide the structure of financial system. The system is critical. I mean, in finance, they are very important. And later on, we will show you how the financial system works. And you can imagine, if we don't have financial system, what will be the consequence? All right. So this is our example. It's a very simple example. So you receive $10,000 from your parent, right? Then you only just need $5,000 for your education. So you decide to invest your remaining $5,000 for short term, right? To earn some interest income. And the bank, right? You decide to deposit your $5,000 in a bank. In short term, here I highlight 3 months, right? And the bank will pay you 5% interest. Next, the bank collect your money with funds from other saver or other term deposit and make a loan to the business. The loan is to a business, a pizza restaurant. The loan is 5-year, long term, and 9% interest rate. Right. Then I like to use my handwritten note to summarize some key points in this example. Right. Okay, you can see in this example, the bank collect the money from saver, then provide the money to the borrower. Right. This image, the bank, right, collect the money from saver and provide the money to the borrower. And the bank receive 9% interest from borrower for 5 years. And the bank need to pay 5% interest to saver for 3 months, right? And you can see return for bank. So return to bank is 9% minus 5%. The bank earns 4%, all right? However, the bank also face risk. Let me highlight 2 risks in the example. First risk is due to the mismatch between 3 months and 5 years. So you can see the bank make a loan to borrower. The bank collect the money in 5 years. On the other hand, saver, this is short term, 3 months. And you can see the mismatch between 3 months and the 5 years. It will create a risk, liquidity risk, right? So saver, they collect, they withdraw their money in 3 months, but the bank need 5 years to collect the money from borrower. The first risk is liquidity risk. The second risk is the default risk. Borrower or the business might go bankrupt. If they go bankrupt, they are unable to keep their promise to pay back the money. This is default risk. All right, so you can see in the example, return and the risk go together. The bank make a return, but they also take the risk. Right? If you want to understand more about financial risk management, we have paper 304 for you. All right. So this is a system, financial system, or let's focus on financial institution. Why the financial institution is important? The reason is very simple. If there is no bank, so you can see the system will be very difficult to work. If you are a saver, you need to find the borrower yourself. On the other hand, money borrower need to find money saver themselves. So you can see it's very difficult. And the bank can help determine the R, interest rate. Interest rate is a very important variable in finance. Or interest rate is a price of money. So bank can decide the interest rate. Right? So this example tell you the bank make a return but taking a risk. And the bank is very important for our financial system. So let's discuss the financial system further. So the system will move the money from saver to borrower. Right? So we have two terminology, surplus spending unit. That means surplus means saver. Right? On the other hand, deficit spending unit or DSU, spender or borrower. Right? On this slide, we show you a graph. You can see how the financial system work. Move the money from saver to the borrower. Here we define two channels. One, the direct financing channel. Second, indirect financing channel. Right. So you can see saver is here, and the borrower is here, right? And the direct financing, you can see lender and the saver, the money will go to the financial market directly. This is direct financing, right? On the other hand, indirect financing, we have the financial institution between saver and the spender. So financial institution collect the money from saver. Then financial institution invest the money in the financial market or make a loan to the money borrower. Right? So this is indirect financing. All right. So for me, indirect financing, we have the financial institution between saver and the borrower. We'd like to discuss more detail in this graph. So you can see the financial security. We have share, bond, and money market instrument. Right? So about that, this is my additional note here. So for financial market, we have short term and long term. So short term, long term, we use 1 year as a threshold, right? So short-term asset, shorter than 1 year. This is our money market, like a short-term government bond. On the other hand, long-term, longer than 1 year. Right? This is our stock market, right? Or equity market. So stock has no maturity date. Or you can say the maturity date is forever. All right. And the bond, long-term bond, longer than 1 year. Right. For the financial institution, that means the commercial bank, they invest in financial asset and provide the financial service. So financial institution collect the money from saver in small amount, then aggregate the fund and then make a loan to the larger amount to the consumer or business and the government. So you can see financial institution collect the money from saver. They can make a loan to the company or to the borrower or invest the money in the financial market. And financial market now we have short-term and the long-term market. Right. The idea is simple. Some investors like to invest their money in short-term. Others they prefer long-term. Borrower again, some borrower like to borrow the money in short-term. Others might borrow the money in long-term. So later on, we are going to show you different types of financial markets. The reason is simple. We have different investors and different borrowers, right? They have different preference. So here, the first preference is short-term, long-term. Right? So now we discuss the direct financing further. So saver and the borrower deal directly with each other, right? That means no financial institution between them. So borrower sell or issue security such as share and the bond to the lender in exchange for the money. So now you can see share market and the bond market. Right? We will have one chapter for share market and one chapter for bond market. And security can be referred to as financial instrument or financial plan. All right. So for me, plan here. Plan is a right to do something. That means bond investor or share investor, they have the right to request money from the issuer or from the company. All right. In particular, share is an equity, right? So share investor, they have the right to request dividend. Right? We will discuss dividend in our following chapter, right? Dividend. And the bond is a debt. And the bond investor, they can claim coupon, like an interest payment, right? In chapter 3, we will discuss the difference between them further. But for me, share or equity, they represent ownership, right? And the bond is a debt, right? So this is the first difference between share and the bond. And the final point, the transaction size is huge in the direct financing, $1 million at least. So the direct financing is for is a wholesale market, is for the institutional investor, not for us. We are individual. We don't have $1 million for that. So later on, I will discuss the investment bank and the underwriting. Right? You will know what is underwriting. It's not for the individual investor. Next, we discuss direct financing further. So to raise funds, company can issue their own security in a financial market. including share and the bond. It's a capital market. Right? So then the company will need help from expert to organize, issue, and sell security in the market. Right? So direct financing, bank is very important. So expert means investment bank. So next slide, we discuss the investment bank and the direct financing. So investment bank specialize in helping company to sell new debt or bond or equity. They provide two services. One, origination, the process of preparing security issue for sale. Second, underwriting is a guarantee that the company will raise the fund it expects from its new security issue. So let me discuss the investment bank and the underwriting further. When a company issues a new share or new bond in the market, they will need the help from investment bank. Or you can say investment bank provide two services. One, origination. So here I give you some example for the origination. So think about you are a company manager. Your company will have a new product or new project, right? And you want to raise the money. You issue the share or issue the bond. Then you have something to do. One, you need to determine the feasibility of the project, the amount of the money, credit quality of the company, or the sale date. All right, which day to issue your share? For example, right now, the market is not good. Maybe it's not a good time to issue the share right now. So you need some expert or professional expert to help you. That is investment bank. All right. So investment bank provide the service. Next, underwriting. So what's underwriting? For me, this is my understanding. So when company issue the share, new share to the market, they don't sell the market to the they don't sell the share to the market. They sell the share to investment bank. All right, and the transaction is huge, could be over $1 million at least. So they sell the each share to investment bank. Investment bank give the money to the company. Then investment bank sell the share to the market and receive the money from the market. Right? And you can see the difference, money paid and the money sale. The difference is underwriting spread. This is a profit to investment bank. Again, when we see the return, you need to consider the risk. Investment bank will make a return. Money sales minus money paid. But the investment bank will face a risk. For example, the share could be not successful. But investment bank still need to pay the money to the company. This one is a guarantee. So company will receive the money for sure. Right? Investment bank will take the risk. Right? So this is underwriting. So I always remember we have two ways to make money in finance. One, provide the service. For example, the origination, providing a service, making the money, no risk. The other way to make money is taking the risk to make money. In this example, you can see underwriting might have a risk. All right. So when company issue the new share, they need the help from investment bank. For me, investment bank, the system provide a guarantee to the company. So company will receive the money for sure. Investment bank will take the risk. Okay. All right, we finished the first topic. Before we go to the next topic, I'd like to review some key points for you. So financial system. When I see the financial system, I know financial system consists of financial markets and the financial institutions or bank, right? And I know direct financing and the indirect financing, right? I hope you remember the image, right? So direct financing, saver and the borrower, they deal with each other directly, right? Indirect financing, we have financial institution between saver and the borrower, right? But even direct financing, banks are important. We have investment bank. I mean, when company issue the new share, they don't sell the new share to the market directly. They sell the new share to investment bank. All right. Then investment banks sell the new share to the market. And I can see the underwriting spread. Spread means difference. All right. Spread is a terminology in finance. Underwriting spread is a difference between money received and the money paid. Right. Okay. This is our financial system. We go give you the overall picture of the financial system. Now we like to discuss the financial markets in more detail. So again, I like to highlight markets. All right. So we will introduce each financial market. Most importantly, comparison is necessary. All right. You compare one market with the other market. Okay, on this slide, we show you the type of financial asset. So we have 4 types of financial asset: stock, bond, foreign currency. All right. So I think they stock. So if you watch the news every day, you can see the information about our stock market. For example, United States S&P or Dow Jones in the United States. In New Zealand, we have New Zealand exchange, all right, stock market, bond market, right, and the foreign currency market, right. Finally, we have derivative security. This is an important topic in finance. So derivative means it's not original, right? We have the forward, future, and the option. Let me explain what's the derivative for you. So stock, bond, foreign currency, they are 3 key financial assets in finance, all right? And the forward, future, and option, they are derivative security. In chapter 3, we will discuss the derivative security further. But so far, I hope you know what's the derivative. So derivative means this security allows us to buy or sell the asset in the future, not today. All right. I can give you an example. If you are the company manager, your company will need, let's say, US dollar. Right? You need the US dollar to buy the product from the United States. You need the US dollar, but not now, 3 months from now. All right. So you need the US dollar 3 months from now. Then you will face a problem. The US dollar value will change over time. All right. So then how can you manage the risk? I mean, the US dollar value is not a constant. In the finance, we have forward and the future and the option to help you manage the risk. So you can buy the US dollar today at a predetermined price. All right. This is the forward, future, and the option. Of course, we will discuss the difference among them in chapter 3. Right. So you can see we have stock, bond, foreign currency, and we have spot market. Spot market means you buy the financial asset today or now. You buy or sell the financial asset today. This is spot. Spot for me is now, right? So either you are buyer and the seller, you make the deal today. But if you want to buy or sell the asset in the future, you can use the derivative market, right? And here we have 3 derivative market, right? So the image like this, right? So today T0, if you want to buy the asset could be stock, bond, or foreign currency. This is a spot market. You can see the S0, S stand for spot market. Spot market price today. But if you want to buy the asset, not today, for example, T days from now, you will face a problem. The price, ST, is an unknown variable. We don't know the price T day from now. So in the finance, we have the derivative market. So in the derivative market, we have forward and the future. The forward and the future price, they are determined. They are determined today. For the option, we have the K. K is a strike price or exercise price. All right. They are a fixed price. All right. This image is interesting. You can see several variables here. So today's price, future or forward price, and today's money, future money, you have the return. Asset, we also have a return for the asset. I use RA. And you know they will have a relation. So in finance, you will see many relation. And for each relation, we have the formula. We have not discussed the finance formula yet. But for me, finance formula is a relation among financial variable. All right, financial variable. And this is very important. If the relation is broken, then we will have an arbitrage opportunity. Arbitrage opportunity is to buy low and sell high, right? So you can see why finance people can make so much money, because they understand the relation among financial variables. And they know if the relation is broken, they can make money with no risk. All right, this is why finance people can make money. So far we have not shown you the detail, but I hope students know, we have many financial equation or formula. But for me, each financial equation or financial formula, there is a relation among financial variables. All right. Okay, so these are type of financial asset. We have 3 key assets: stock, bond, foreign currency. And we have derivative security market. Right? Derivative security market will allow investors to buy or sell the asset in the future. Next slide. We have more. Money market versus capital market. So money market is short-term market. Capital market, long-term market. All right. So short-term, again, short-term, shorter than 1 year. Long-term, longer than 1 year. All right. Next, primary market and the secondary market. So primary market, where company initially sell new security issue, is a primary market. Secondary market, where the owner of security can sell land to other investors. So the image, this is my way to remember. Primary market, like a first-hand market. So issuer or the company, they issue stock or bond to investor. And investor provide the money to investor. This is the primary market. Secondary market is a transaction between investor. So we have seller and the buyer, right? So you can see the money movement is between investor. All right. So according to this image, you can see the company or the security issuer, they will not receive the money from secondary market. In the secondary market, it's a transaction between investor. So I have a question for you here. So company will not receive the money from the secondary market. So company will not pay attention to the secondary market? No. Company will pay attention on the secondary market. The idea is simple. If the secondary market is no good, primary market will be no good as well. All right. So to understand the idea in a better way, I was thinking the car, right? Automobile. The car, we have first-hand market. If the new car is a new car, for example, they say Toyota, right? They sell the car to the buyer, and the buyer give the money to Toyota, right? But if the second-hand car is a transaction between car owner. So you can like we have seller and the buyer. So the money will not go to Toyota, but Toyota will pay attention to the secondary market. Because the secondary market is no good, their primary market will be no good. All right. I hope you understand the idea. Later on, I will give you an example, like a company. When they issue the share or issue the stock, after the first-hand market, the share will go to the second-hand market. But if the price is no good in the second-hand market, the company will buy back the share or the share repurchase to rise up the share price. All right. So this is the point. The company will not receive the money from second-hand market or secondary market, but they do care. They take a look. They do pay attention to the first-hand secondary market. All right. Okay, on next slide, we show you the market specialists. So they facilitate transaction or help the transaction in the secondary market. So for individual investor like us, we invest our money in the secondary market. All right. Then we need the some professional expert to help us the secondary market. Here we have two professional experts. One, broker. Second, dealer. Right. So broker make specialists who they are market specialists who bring buyer and the seller together for a sale to take place. Right. So they get a charge for the service. They take no risk. All right. So, on the other hand, dealer they will buy and they sell the security on their own. So dealer will bear the risk. So it's a difference between broker and dealer. All right. If you watch some movie like a Wall Street Journal movie, right? They are broker, right? So they use your money to invest. If we lose the money, they don't lose it because they just provide the service. All right. They don't take a risk. All right. On the other hand, dealer they buy and they sell the security in the market on their own, so they will bear the risk. Next slide, we discuss the exchange market versus over-the-counter market or OTC. So exchange, is organized market, provide a platform and facility for member to buy and sell security or other asset. So exchange, more rule and regulation. So for me, exchange, when I see it is a big market and a lot of rule and regulation. For example, in the US, they have NYSE, New York Stock Exchange. In New Zealand, we have New Zealand Stock Exchange. All right. So the exchange is for big company, and they have to follow some specific rules and regulation. But we don't need to discuss the detail, right? So we just know the key concept: exchange, rule and the regulation, big market for big company. On the other hand, OTC, over-the-counter market. So they are the security not listed on exchange, right? And we have the small company in the OTC market. No central trading location, and this market is for small and relatively unknown company. Okay. On this slide, we discuss the money market versus capital market. So money market for me is short-term, shorter than 1 year. It's a wholesale market. Transaction is huge. For example, 1 million at least. Okay, so this market is for institutional investor, like an investment bank, and the risk, low risk and high liquidity. So when I see the money market, that means short term. So if you are investor, you will receive your money within 1 year, short term. And that means high liquidity. When I see liquidity, mean I will receive the money fast. And because it's a short term, the risk is low. Right? So it's the money market. Next, we compare money market with capital market. So capital market means long term. Long-term debt and corporate share they are capital market. So company will raise funds to finance capital asset such as property, plant, and equipment. So when I see the long term, I know higher risk or default risk, right? And longer maturity, right? So if you receive the money late, that means you have higher risk, right? And a lower liquidity. So we finished the discussion on different type of market. We have many markets, but finally, I like to make a comparison for you. So for me, it could be important. We learn different market, but please understand the differences between them. So first, we have 3 major financial assets: share, bond, and foreign currency. Right? In addition to the stock market, we have derivative security market, including forward, future, and option. So when I see the derivative, this one I know, derivative security will allow investor to buy or sell the financial asset in the future. Yes. Sorry? We have FINAN101. If you want to understand the topic more, we have FINAN101 for you. All right. So here we just give you a introduction. It's a 101 introduction. So derivative market would be, for me, is very important. It's the most important innovation in finance. And it's necessary because we not just only buy the financial asset today. Sometimes we need to buy the financial asset in the future. And when we buy the asset in the future, we know the asset price is not a constant. So how to manage the the asset price, the management, risk management. The tool is derivative security. Right? Thank you. And next one, we introduce the money market and the capital market. For me, the difference between them is shorter than 1 year versus longer than 1 year. Right? And we discuss IPO, primary market. IPO stands for initial public offering. All right, initial public offering. So IPO market. So company will receive the money from the IPO market. Right? They issue the share to the investor, receive the money from investor. This is IPO market. After IPO market, the share will go to secondary market. It's a transaction between investor. Right? Here is the point. The company will not receive the money from secondary market, but they do keep their share price in the secondary market. For example, they have the share repurchase. If the share price in the secondary market is too low, they will buy back the share price. They will buy back the share to rise up the share price. Okay, this is IPO versus secondary market. Finally, exchange market versus OTC market. So when I see the exchange market, I know this market is for large company, right? And this market has more regulation. OTC market is for small company and less regulation, right? Okay, we finished the discussion on the first two pockets. We have two more for our Friday. Before we go, we recall our attendance. So give me the minutes, I will show you the QR code. All right, student, now you can use the QR code to recall your attendance. After that, you are free to leave. I will see you on Friday. Online student, I also show you the QR code for you.